Bitcoin just lost $1.3 trillion in total market value. Should you be buying right now, or is this a trap? What if institutional investors know something retail traders don't? In the next 8 minutes, you will learn exactly when to accumulate crypto, the 3 strategies professionals use during crashes, and the 1 metric that tells you the bottom is forming. This is not investment advice, but it is real data. Stick with me. The crypto market did not crash in isolation. Bitcoin fell because the entire macroeconomy shifted. Interest rates climbed higher than expected. Inflation fears returned. Governments announced stricter crypto regulations. Tech stocks tanked and money fled to safety. When risk appetite disappears, investors sell first and ask questions later. Bitcoin and high-growth assets get hit hardest. Your instinct right now is probably fear. That fear is exactly what creates generational buying opportunities. Here is the critical part. Crashes like this one happen roughly every 4 to 5 years in crypto. This is normal. This is the cycle. Professionals expect it, they prepare for it. Do you know what they do during crashes? They accumulate, but not randomly. They follow a specific playbook. You need to know that playbook before you move money. Institutional investors do not dump all their capital into a crashing market at once. They use a technique called dollar cost averaging. This means buying fixed amounts at regular intervals as the price drops. If Bitcoin falls from 60,000 to 30,000, they buy at 55,000, then 48,000, then 35,000. Each purchase lowers their average entry price. If the price keeps falling, they still own more Bitcoin at better prices. If the price bounces, they have already started accumulating. This removes emotion from the equation. Your emotions tell you to wait for the bottom. Your emotions might cost you thousands. Dollar cost averaging means starting now, not waiting. Start small. Buy the same dollar amount weekly or monthly for the next 12 to 18 months. This strategy has worked through every crypto bear market in history. The reason it works is psychological. You remove the pressure of timing the exact bottom. You spread your risk. You accumulate continuously as prices normalize. Most retail traders fail because they wait for permission from the market. The market never gives permission. The bottom is only obvious in the rearview mirror. Professional traders watch one number obsessively during crashes. It is called the Fear and Greed Index. This measure tracks market sentiment from 0 to 100. Readings below 30 signal extreme fear. Extreme fear is when most traders have capitulated and sold. It is when journalists write headlines about crypto being dead. It is when your friends tell you they got out completely. That is when institutions start buying aggressively. Right now, the index is approaching 35. History shows that every time this index drops below 25, Bitcoin has bottomed within months. The last time it hit that level in 2022, Bitcoin was trading around $16,000. That was 18 months before it hit 60,000. Your question should be, am I waiting for the index to hit 20? Or am I building my position while other people panic? The second approach wins. The data proves it. But here is what most people miss. You do not need to wait for perfect conditions. You need to start positioning. You need to build incrementally. You need to have capital ready when the real capitulation happens. How much of your total portfolio should be crypto right now? Financial advisors typically recommend 3 to 5% for conservative investors. Moderate investors might go 10 to 15%. The key rule: only invest money you can afford to lose completely. Never borrow to buy crypto. Never use margin. The crash becomes catastrophic when leverage is involved. Your allocation depends on your risk tolerance, your time horizon, and your financial stability. If you have 6 months of emergency expenses saved, if you have no high-interest debt, if you have a stable income, then crypto belongs in your portfolio. In a bear market, your crypto position will drop in value. That is the deal. You accept that to participate in the upside when markets recover. Here is the psychological framework. Treat your crypto allocation like venture capital. You expect losses on some positions. You expect volatility. You expect recovery cycles. You do not panic sell. You do not watch prices hourly. You review your allocation quarterly. You rebalance annually. This removes emotion. This focuses you on long-term fundamentals instead of short-term price swings. History shows us the pattern clearly. Bear markets end. Recovery begins slowly. Early accumulators capture the biggest gains. Bitcoin has recovered from every single crash in its 15-year history. Every crash looked permanent at the time. Every crash recovered, then generated new all-time highs. Your decision today shapes your outcome in 2026. If you wait for signals that feel completely safe, you will enter too late. Professional investors buy when conditions feel most uncomfortable. They accumulate when prices have fallen 70 to 80%. They increase their position size right before recovery begins. This sounds counterintuitive because it is counterintuitive. Your brain tells you that falling prices mean stay away. Your brain kept humans alive in caveman times. Your brain is wrong about markets. Markets reward people who buy when others are terrified. Look at the timeline. Every previous crypto bear market lasted between 12 and 24 months. We are roughly 12 months into the current cycle. That suggests we could be approaching the transition phase. Does that mean the bottom is tomorrow? No, it means the opportunity window is closing. The time to build is now, not later. The time to reduce your fear is through action, through starting small, through committing to the strategy. Remember these three things. First, Bitcoin crashes are cyclical and normal, not permanent. Second, dollar cost averaging removes emotion and builds your position efficiently through volatility. Third, the fear and greed index shows you when professional investors activate, and we are close to that level right now. Your next step is simple. If you believe in crypto long term, start building a position this week. Open an account. Buy a small amount. Schedule automatic purchases for the next 12 months. Do not wait for perfect conditions. Build through the discomfort. Subscribe to Wealth Pulse for daily market analysis, investment strategies, and financial breakdowns that help you make decisions with confidence, not fear.